Hey traders, welcome back to LutaMarkets. In today's session, we're unlocking one of the most powerful and underrated concepts in price action trading, the liquidity grab candle, and more importantly, how to use it to spot clean reversal entries with precision. If you've been struggling with getting stopped out just before the market takes off, or entering too late when the move's already halfway done, this video is going to shift your perspective completely. We're going to break it down step by step. What a liquidity grab actually is, why smart money creates these traps, and how you can position yourself for high probability entries right where institutions are getting in. No indicators, no lagging signals, just pure price action, market psychology, and smart entries. Let's dive in. Let's start with the basics. What exactly is a reversal pattern, and why do liquidity grabs play such a crucial role? In trending markets, price rarely just turns around without a reason. Before any significant reversal takes place, institutions, those with the power to move markets, often make a calculated move to hunt for liquidity. This means they drive price into areas where they know stop losses are clustered, usually just beyond key support or resistance levels. When these stops get triggered, they provide the liquidity needed for institutions to enter large positions. This move is known as a liquidity grab. A typical liquidity grab starts with a sharp move in the direction of the current trend. Say, a sudden drop in price during a downtrend. That move usually pierces below a previous low, causing panic among retail traders. Stop losses get triggered, breakout sellers jump in, and a surge of orders hits the market. But then, instead of continuing lower, price snaps back and closes higher, forming a strong bullish candle. That reversal tells us everything. It signals that the downward move was not a true continuation, it was a setup. A trap. Smart money used that drop to collect liquidity, and now they're reversing price in the opposite direction. The aggressive rejection and the strong close back inside the range show that control has shifted from sellers to buyers. This is what we call a liquidity grab candle, a powerful signal that the market may be about to reverse. But here's the key, the best entry doesn't come at the moment of the grab itself. It comes on the retracement. After the initial reversal, price often pulls back to retest the same zone where the liquidity was grabbed. This is where patience pays off. When price returns to that area and shows signs of respecting it, like slowing momentum, bullish rejection, or a fresh impulse, that's where high probability entries form. It's the smart entry, with a clear stop below the grab and plenty of upside potential. Understanding this sequence, grab, reversal, retrace, and bounce, is what separates reactionary traders from strategic ones. It's not about predicting. It's about recognizing intent and positioning yourself with the institutions, not against them. Now let's talk about what happens after the liquidity grab and initial reversal. Once price makes that sharp move in the opposite direction, usually showing strong bullish momentum after a downward liquidity sweep, it doesn't just shoot straight up forever. It often retraces. And that retracement is where the real opportunity lies. After that initial push, price tends to come back down and revisit the same zone where the liquidity grab occurred. This isn't a coincidence, this is where institutions previously entered, and where they are likely to reload their positions. It's a critical point of interest. When price returns to that zone, what we're looking for is a clear reaction. This is the market telling us whether the level still holds value. You might see a rejection wick, a shift in momentum, or even a lower time frame bullish engulfing candle. These are your cues, your confirmation that buyers are stepping in again. Here's how to approach the entry. Wait for price to return to the area where the liquidity grab happened. Watch for reaction signs, wick rejections, bullish structure shifts, or any price action that shows buying pressure returning. Place your stop just below the low of the liquidity grab candle. This keeps your risk tight and controlled. Set your target at previous highs or at the next area of imbalance, where price moved fast and left a void. This strategy removes emotion from the equation. You're not chasing price after it's already moved. You're waiting patiently for price to return to a high probability zone, and you're entering with confirmation. You're aligning yourself with where institutions are most likely adding to their positions, not reacting like retail traders. By entering this way, you gain not just a better price, but also a better edge, because you're trading with the flow of smart money, not against it. Let's break down exactly why this setup is so effective, not just once, but consistently across different markets and timeframes. Smart money, whether it's institutions, banks, or large funds, can't just click buy or sell like retail traders. Their orders are massive, and if they try to execute all at once, they'll move the market against themselves. So instead, they create liquidity zones, areas where they know they can fill large orders without too much slippage. One of the easiest ways for them to do that is to drive price below a key low. That's where retail traders usually place their stop losses or breakout sell orders. Once price dips below, it triggers those stops, creating a surge of liquidity. But instead of continuing the move, price quickly reverses. That reversal tells us the sell-off wasn't genuine, it was manufactured. This is where the power of this setup comes in. By patiently waiting for price to return to the same zone where the liquidity grab occurred, you're putting yourself in sync with the market's real movers. You're not guessing or anticipating, you're reacting to clear evidence that smart money is active in that area. When price pulls back and respects that level, either by rejecting it, stalling, or reversing, it confirms that buyers are defending it again. That bounce isn't random, it's structure, it's intent, and it's opportunity. This is what makes the entry so high probability. You're entering at a level that's been proven to hold significance. You're not entering late. You're not trading off emotion. You're entering with confirmation, in alignment with the direction that institutions have likely chosen. And that's the edge, trading not from reaction or fear, but from understanding and alignment with the flow of real market power. If you've ever spotted this pattern unfold in your own trading journey, whether it played out exactly as we discussed or even if you caught it a little late, I want to hear your experience. How did it feel when you saw the market reverse exactly where it swept those lows or highs? Did you catch the retracement entry, or did you miss it and realize afterward what had happened? Let's talk about it in the comments. And if you're finding this kind of breakdown helpful, let me know if you'd be interested in a part 2. We could take this strategy even further by incorporating tools that add extra precision and confidence to your entries, like Fibonacci retracements to pinpoint optimal entry zones, order blocks to trace institutional footprints, or multi-timeframe analysis to align with the bigger picture. The goal here is to give you a complete, adaptable framework. Something you can use consistently, not just a one-time setup. If this content has helped shift your perspective on price action, do me a favor, like the video, subscribe to the channel so you don't miss future uploads, and share this with another trader who's looking to sharpen their edge. They'll appreciate it, and it helps grow this community of serious, smart traders. Thanks again for tuning in to LutaMarkets, where we don't trade off hype, we trade off intention. See you in the next one.